Hey guys, welcome back to the second session of Chapter 3. In this section, we are going to go over the calculation of the expected return of a portfolio. We are also going to try to capture the association of the individual asset that is being put into one portfolio. Now, remember, this is not our first time to come across the calculation of expected return. We actually learn how to calculate the expected return of individual asset in Chapter 1. So let me write down the formula using my magical pen. So remember, we have the possibility here that indicates the possibility or probability of certain outcome and times these specific individual returns. And then we add all these products together. And then we have the expected return of individual asset. Now, the calculation of expected return of portfolio is actually very similar to the idea here. We just replace the probability with weight. But what is weight? It's a value weight. Let me make an example. We have a portfolio that is being established by $100, and $20 are being put into one asset, let's say asset A. Now, the weight of asset A in this portfolio is given by $20 divided by $100. So that gives us $20, which is the value weight of this investment inside of this portfolio. So that's how value weight works. Now, the expected return of a portfolio is actually quite easy. It's just the weighted average of the expected returns of individual investment in this portfolio. Now, let's see an example. Here we have a risky investment build up the portfolio. We have four investments. Why? Because we have 4 different weights. All of them add up to 1, indicating that here represents the full, let's say, accountability, right? So we have 4 different individual assets, each have different returns, which is being given here. So what we want to do is times the return together with its corresponding weight inside of this portfolio. And then we put the product here. And then we do the rest just as the first one. And then we have 4 products showing the result between, let's say, we times the individual returns with the weight of these individual investments. So we add them together. We have 11.5% as the expected return of this portfolio, which is value weighted average. All right. So that's how we calculate the expected return of a portfolio. Remember, only 2 factors are being taken into account here. First is the weight of the individual asset. It's the value weight. And the return of individual asset. We do a value weighted average. That average is our expected return of this portfolio. Easy as that. Now, remember that in the first session, we have made an example with the bank loans and the risky securities. We show how a bank loan application can affect our risk tolerance in terms of picking the right risky securities to invest. Remember that? That association, that interaction is actually covariance or correlation. Covariance shows the, let's say, a certain magnitude of the association between different assets. Now, covariance, to be put in a more statistical term, is it values how two variables moves together relative to their individual mean. So whether they move into the same direction, whether they move at the same time, and how about their moving magnitude. So those are the three dimensions of these co-movements. Now, the presence of correlation is actually everywhere. Let's make an example from the reality. We all know the industrial effect. The industrial effect means that a certain common factor inside of the industry that is going to affect the firms that is being listed in this industry simultaneously. So that is the industrial effect. It do so, for example, when the oil price goes up, the delivery fee might goes up, right? The postage might goes up. So that's a correlation. And the oil price goes up affect every companies that's gonna have, let's say, oil expenses, right? So that's a common factor here. Now, the common factor, the industrial factor, affect firms' operations by affecting its sales and, let's say, profits. So that affects their profitability. We know that investors make their judgment about a firm's prospect based on current operations because that's their fundamentals that include, let's say, the profitability, the most important one. And we know that a firm's stock price actually reveals how the investor have an overlook for this firm's future. And they form that decision based on current operations. So that's how the industrial effect transfer to factors that affect profitability and transfer to factors that affect stock price, which lead to a co-movement in terms of the stock price movement for every firms in this industry. So that's how we can see the correlation in a practical term being put into the package of industrial effect or the industrial common factors. Now let's see the formulas. Now, we have seen that the covariance captures these co-movements, these move together relative to their individual mean. So what we do is we use the individual value to minus, or let's say to see their difference, to see their distance together relative to its individual mean. And then we do the same for the other variables, and then we times them together. Remember, covariance is the correlation between two variables only. So if you have two assets inside of a portfolio, you need to calculate one correlation. If you have three assets in the portfolio, you need to calculate three correlations. That's 1 and 2, 1 and 3, 3 and 2, right? So in our class, we mainly talk about two asset portfolios, so we only need to calculate covariance once. Well, let's see an example. Here are the monthly returns in 2010 for market index and bond index. So here are the monthly observations, the two variables corresponding to the same time period of 1 month. And then here is how we calculate the covariance. Here is the mean. The mean is given by adding all the observations together and divided by 12. And here is the mean value for the bond. Here is the mean value for the stock. And then the first step is to calculate the difference between the individual observation and relative to its own mean. So that's what these two differences represent. It captures the individual movement relative to their individual mean in January. Now, the rest one would be capture such co-movement or relative movements from February to December. Now, the next step is we times these two differences from the same month, remember from the same month, together and we get a product. So we times them again in February, and then we get 12 products. We add them together to get a sum. Now, the next step is to consider the degree of freedom. We have 12 observations, so n minus 12, n minus 12. And then see here is actually 11. Why? Because what is being divided here is actually n minus 1. That's why we need to justify that to avoid estimation bias in calculation of covariance. Now we can also do that in the calculation of variance, just saying. Okay, notice an interesting trend. That is, see here. Positive, positive, positive. So that means these two observations indicates that the individual value of stock and the individual value of bond both move upward in relation to their individual mean at the same time during July. So positive change times together equals to a positive result. So that means they move together at the same time, right? Now let's see a different one for the November. Now negative times negative equals to positive. So that means these two variables both move below its individual mean at the same time during November. So that's why this product here is positive. So a positive covariance indicates that these two variables move into the same directions at the same time, regardless of its uplifting or downwarding. It doesn't matter. As long as they are in the same direction, we have a positive correlation. Now, see another one. For example, this one here. Negative times positive equals to negative. That is because, so stock index moves below the mean, bond index moves above the mean. Times together get a negative correlation because they move into different directions. Now, we have to get the result of minus 5.06. So, is it a large result? Does that indicate a strong correlation or a weak correlation? Well, we cannot say until we calculate the standard deviation of the stock returns and the bond returns. Because if these two theories are volatile, and then this represents a small correlation. If these two theories are, let's say, are small, indicating that these two are very stable, so the correlation actually represents a very large correlation. So that means we cannot directly compare two different sets of covariance. What we need to do is we standardize the covariance into a way that two different sets of covariance can be compared directly. So we can do that by standardize the covariance, which is we divide the covariance by the product of individual standard deviation. So, some features about this standardize. When we get the result, which is referred as R, it shows the strength of correlation. This correlation is being captured, being standardized into the form of -1 to +1. And this value is being referred as correlation coefficient. It can only take the value from -1 to +1. Now, a positive correlation coefficient indicates a perfect positive relationship. It means that these two variables move together, move simultaneously into the same direction with very comparable magnitude. Now, a -1 correlation indicates a perfectly negative correlation. It indicates that these two variables move into different directions at the same time with comparable magnitude. So, in a way, these co-movements into different directions can be offset by each other. So that is one key feature about a negative correlation, especially a perfectly negative correlation. Now remember, the lowest correlation possible in reality is not 0, it's -1. 0 indicates that there is no, let's say, linear correlation between two variables, which is not the lowest correlation possible. Now, this line shows the linear relationship between the return of stock index and the return of bond index. We can see that this is a downwarding line, has a negative slope, because its covariance is negative. So that means they have a negative correlation. So that's why when we draw this linear line, we can see a downward trend and also being captured by this negative slope here. This negative slope, again, is in line with the negative correlation. Also, we have one point need to be mentioned here. So, see these two standard deviation here. They are the square root. So that means they are two positive results times together, right? So that means the covariance and the correlation coefficient must take the exactly same sign. If the covariance is negative, the correlation coefficient must be negative. There cannot be another way around. Now, if we are looking at the, let's say, the correlation between a risk-free asset and a risky asset. Remember, what is the standard deviation of a risk-free asset? It's 0, right? Then this ratio wouldn't be statistically, let's say, meaningful. So it means, at least it means that the correlation coefficient between a risky asset and a risk-free asset is 0. Because there is no relationship between these two. One is risky, one has no risk, so there's no common factors. So that is one example of two investments having a correlation coefficient equal to 0. Whether equals to 0 or -1, how does the correlation coefficient transfer into determining the risk of portfolio? And can we use that to the advantage into risk management, and can we form an investment decision by looking into the correlation between the individual asset inside the portfolio? Now, that's what our next class is about. All right, stay tuned for that. See you next time. Bye-bye.